everyone. Welcome to RICS Monitor, CP's quarterly podcast series that tracks sentiment toward real estate across the globe. I'm Laura Calugar, Senior Editor with Commercial Property Executive. The Royal Institution of Chartered Surveyors in London just released its second Global Commercial Property Monitor survey this year. How do investors and occupiers across the world feel about the unexpectedly steep trade barriers imposed by the Trump administration? We'll try to answer this question and many others over the next few minutes. As usual, Senior Economist Tarrant Parsons is here to provide the latest updates. Hi, Tarrant. Thank you for joining me today.
Hi, nice to speak to you.
So the word tariffs seems to be on everyone's minds nowadays. How much do commercial real estate investors and occupiers worry about the impact of these tariffs? Is it too soon to tell from the survey?
Yeah, well, I mean, tariffs are clearly dominating the business news at the moment, and obviously the related uncertainty has kind of been reflected in a sharp pullback across financial markets, although these have settled down a little bit following the 90-day pause that was announced. I think in truth, the so-called Liberation Day, some of the surprises that came from those announcements, that came about midway through our collection window for this quarter, and so the reaction may not be fully captured in our figures, but to be fair, I think worries around tariffs have started even earlier in the year, and already there are notable concerns in some markets. So I think Canada being one example where the impact is very much evident. So a lot more caution is coming through across our numbers there. I think across the globe in aggregate, though, the latest feedback is quite resilient. In fact, there are even some modest signs of improvement between the Q4 and the Q1 results, particularly when it comes to investment demand. So, I mean, perhaps that would have been even more significant if not for kind of trade policy uncertainty. But we'll have to see how this all plays out moving forward.
And how does the commercial property sentiment vary across world regions in general? What has the latest survey revealed? What's the general view?
Yeah, it's still very divided at this point in time. The Middle East and Africa continues to post the strongest results. That's picked up by our kind of headline commercial property sentiment index that remains firmly positive across the region. The Americas overall, despite what's going on with trade policy, the region does continue to show stronger momentum than most others, although it is becoming a bit more patchy. So where we do see positivity, it's principally mainly linked to the United States because, as I say, Canada suffered a setback at this quarter, so a little bit more divergence in that region. Europe, I would say, is showing signs of kind of stabilizing, but it is still uneven, and some of the large markets, France and Germany, they are lagging and yet to see any meaningful turnaround. And then Asia Pacific remains the weakest region by some margin, really dragged down by China, but even there, we've got India and Japan bucking the wider trend. So a lot of variation both across and within regions still.
We'll get to dive deeper into each region a bit later. But for now, please tell me what your latest survey shows about global investment inquiries for each asset class.
Yeah, so interestingly, at the global level, all three mainstream sectors actually saw rising investment inquiries for the first time since 2018. So that is quite significant. So industrial, still seeing the strongest improvement. That's not particularly surprising. But our investment demand metric for the retail sector actually posted its highest reading since 2016. Now, of course, it's been a very tough kind of almost decade for retail, but some more positivity does appear to be coming through now. And then our measure of office investment inquiries also returned to kind of outright positive territory for the first time in, I think it's 12 quarters. So it does appear that investors are just starting to maybe dip their toes back in. We're still talking about the early stages of a recovery. In truth, there's still obviously a lot of lingering caution, but an overall improvement, a slight improvement, is evident this quarter.
What can you tell us about the credit conditions indicator? What are the areas of concern? What's the tone of market sentiment?
Credit conditions are still improving to some degree. I think the pace of that improvement has slowed from what was coming through during the second half of last year. I think that the bond market sell-offs that we've seen are at least slightly concerning and could kind of tighten lending conditions if they were to continue to rise. But I think for now, financing is appearing to be kind of readily available in some of the strong Middle Eastern markets, but I think lenders are still pickier in other parts of the world. And I think a lot of eyes are still watching the Federal Reserve. Of course, within the US, the last couple of inflation releases have actually provided some positive surprises. So CPI has come in slightly below expectations, but this is all referring to the picture before the potentially inflationary impact of the tariffs, and so that really does kind of cloud the outlook, even if it is expected to be kind of a transitory adjustment. I think that the Fed is still going to want to make sure that is the case and not kind of risk letting inflation run too hot. And so we're still not expected to see much loosening, if any, from the world's largest central bank this year. And if that does play out, then I think there's probably not a huge amount of scope for credit conditions to loosen to a significant extent across the global sector.
Another relevant indicator for commercial real estate sentiment that I know you closely monitor in your surveys is development starts. How does the long-term perspective look like?
I think globally, development starts are still weak. Our indicators are really still pointing to a downturn in that type of activity. Obviously, when you disaggregate the data, unsurprisingly, there's some stark contrasts. You've got the UAE and India really kind of charging ahead, a lot of construction activity taking place, but across China, France, Germany, for instance, these types of markets are still seeing especially subdued trends in commercial real estate development. So I think it's clear that developers are targeting safer markets right now with really strong occupier fundamentals, strong occupier demand, and rental growth. And then across others, many others, conditions don't yet appear to be kind of ripe enough for a significant rebound in commercial real estate development just yet.
In this whole context, many survey respondents see alternative asset classes as great performers, particularly data centers. What are the expectations for alternative asset classes?
Yeah, data centers are very widely expected to be the strongest performing sector in terms of capital value and rental growth over the next few years. I think this continues to be fueled by the increase in the use and the adoption of AI along with other kind of digital technologies. I would say that these operations data centers, they are very power intensive though, and some of the largest markets currently, so you look at London, Singapore, Tokyo, Amsterdam, you could include all of these kind of hotspots for data centers currently, they may become saturated before long, and therefore this growth could spread to other more regional markets in the future, so something to watch out for. Also, as you mentioned, other alternative asset classes such as multifamily, residential, student housing, aged care, these are all kind of outperforming more traditional sectors right now, and that's really because they're supported by demographic trends rather than being kind of hindered by the structural changes that are still acting against some portions of the office and retail markets.
Mhm. And how do respondents assess property values? What's the most prevalent response?
Yeah, globally, it's I think 44% of respondents feel that commercial real estate is currently at kind of a fair value level. That figure hasn't budged all that much in the past year. There are exceptions to this. I think Brazil and China, two markets that pull out, actually have the highest share of respondents that feel the market is cheap, although that doesn't mean investors are kind of wanting to kind of snap up properties, especially in China. As the likelihood is that values in overall terms could continue to fall. And then at the other end of the spectrum, you've got markets such as Japan and France that top the expensive kind of list, even though I would say they're experiencing contrasting demand conditions at present, which is interesting. But generally, markets aren't seen as offering real bargains right now, and that's not really been helped by recent moves in bond yields. But of course, selective opportunities do exist.
Now, let's do our usual tour of the world to find out how occupier and investor sentiment looks like in each region. We'll start with APAC, where there hasn't been much improvement from your previous survey, has it?
No, there hasn't been a great deal of improvement. It's still very much a mixed bag across the region. China and Hong Kong, quite significant markets that are dragging down the regional numbers, and we're seeing occupier demand falling across all sectors in those two nations. But then you have India and Japan, as I mentioned earlier, real bright spots. I think a lot of these survey comments talking about India really do describe the market as booming, and rents and capital values rising quite a significant pace. And then you've got more kind of middling markets. Singapore was more positive a little while ago. It's kind of flattened out now. Australia quite flat. New Zealand, I think, has been struggling, but maybe some green shoots of recovery there in terms of demand and expectations more recently. So yeah, really variable across the region. I think that also quite a big theme is that prime assets in some of the more stable markets, they are expected to deliver quite solid returns, but it's really secondary in many parts of the region, secondary tiers of the market that are set to struggle.
Meanwhile, Europe seems to have overcome a difficult period with an increasing number of respondents sensing that the market has now entered in the early stages of an upturn. To what extent have pessimistic views diminished across the European continent?
Yeah, I would say there are quite clearly signs, some more positive signs coming through in Europe. I wouldn't want to get kind of too carried away, but as you mentioned, the share of respondents that are seeing an upturn now, that has seen quite a noteworthy move higher from 26% in Q4 to 37% in the Q1 figures, and that is the best kind of signal that we've had around the mood since early 2022. You've got Southern Europe, so Spain and Portugal, that these are really leading the rebound, seeing very strong growth, not just compared to the rest of the region, but also actually compared to a lot of global markets, very strong economic growth coming from those nations as well. But then, as I mentioned, Germany and France, sentiment there remains quite gloomy, and in fairness, they are the largest euro area markets. But I think with the ECB having lowered interest rates by more than most major central banks over the past 12 months, that positive stimulus should continue to feed through and maybe build as the year progresses. And so credit conditions are improving, and that should provide further support moving forward. So I think the overall verdict for Europe is early stages of recovery, but it's still uneven and very fragile in places.
Meanwhile, respondents in the Middle East and Africa seem to be the most upbeat when compared to respondents from other regions. What is fueling optimism in this part of the world? Which countries in the region would you highlight and why?
Yeah, Middle East and Africa is the kind of global outlier, if you like. Much more positive results are being returned there compared to the rest of the world. The UAE, Saudi Arabia as well, the real powerhouses in terms of growth across the region. They're attracting foreign investment and continuing to see really strong expansion. I think this is being fueled by the government's aims to diversify their economies, a lot of infrastructure spending, and it does appear that they've been successful in creating a pro-business environment, which I say is very important for that international investment element to this. I think in other parts of the region, or another country worth mentioning, actually pulled it out last quarter. South Africa is improving and showing some optimism after a really prolonged period of weakness across the market. So there are several positive examples spill out across the region. There's a little bit, or there's a caveat to some of this kind of exuberance, I would say, and that is that nearly 50% of respondents in the UAE and Saudi Arabia now feel that the commercial real estate market is kind of turning expensive, and so that could mean that this rally slows further ahead. But for now, momentum remains strong.
And finally, the results across North America point to a growing gap between the US and Canada. Tell us more about the contrasting performance between these two neighboring countries.
Yeah, I think the divergence this time is very much associated with the fallout from the tariffs. Of course, Canada and Mexico are the most dependent on trade with the United States, meaning that these measures changes could cause the most significant disruption across their economies. And what we see in our feedback from Canada is that investor demand has been hit, it's been knocked back right across the board, really. And there is a general sense that this all could lead to a more significant downturn. But for the United States, although there are elements of the latest data that are perhaps a little bit softer than before, overall, I think the results are quite resilient in the face of this uncertainty. Capital value expectations are generally positive, at least away from secondary markets. And so that is the reason why there's more of a gap opening up between the two nations at this point in time, whereas Canada seems to be quite clearly adversely affected by recent kind of news flow. The United States, up to this point at least, hasn't suffered the same kind of deterioration in sentiment.
So what are your expectations going forward? The 90-day pause on tariffs is set to expire over the next months. Should investors and occupiers prepare for a recession, at least in the US, if not a global one?
Yeah, so that 90-day kind of pause on the tariff, that just obviously creates another event on the horizon that could then induce some major financial market volatility as that deadline draws near. That would obviously be unhelpful for global economic growth. Hopefully, there will be a more positive or constructive resolution to all of this. I can't guarantee that, of course. I think the messaging from the US administration has been yeah, quite confusing in recent days, pretty erratic, and I think it makes it almost impossible to predict the final outcome. So, kind of with that in mind, in a worst case scenario, potentially there could be a recession. I still think that tariffs will be scaled back in the end, and therefore, while I would cut or trim any global GDP growth forecasts, I wouldn't make dramatic adjustments just yet. I expect the United States economy to kind of slow and so growth to weaken, but I wouldn't foresee it falling into recession this year. That's my kind of central case, but of course you can't rule it out, a recession out entirely, at least until we have some certainty about trade policy.
Right. Thank you very much, Tarrant. I appreciate your time.
Thank you.
Thank you everyone for listening. If you liked this episode, please rate and review it on the podcast platform you're using. The next RICS Monitor episode will be available in late July. But until then, check out cpexecutive.com regularly for the latest news, trend stories, and insights from high-profile executives. I also encourage you to share your own voice with our readers by clicking on the CP Executive Council button at the bottom of our homepage. Till next time.